SpaceX is hard to reduce to one label. It is a launch company, a satellite broadband network, a crewed space contractor, and a long-duration infrastructure story at the same time. That breadth is the appeal. It is also why valuation matters. The core question is simple: does an already rich price leave enough room for technical risk, regulatory risk, and governance concentration? This video separates company quality from investment quality and focuses on the operating model, the market signal, the competitive map, and the failure points that matter most. The point of this format is speed with structure. We do not chase noise. We start with the top signal, test it against macro conditions, and only then build a tradable conclusion. SpaceX started in 2002 with a narrow goal: make space access cheaper and more capable. Falcon 9 turned reusability into a cadence business. Crew Dragon proved the company could move beyond cargo. Starlink added the recurring layer. That is why SpaceX no longer looks like a project-based aerospace contractor. It is a vertically integrated platform across aerospace, telecommunications, and defense-adjacent infrastructure. Launch matters today. Starlink is what can compound tomorrow. Reuters described a December 2025 secondary transaction that valued SpaceX at about $800 billion, with shares around $421. It also reported buybacks of up to $2.56 billion and a CFO memo that referenced possible 2026 IPO preparation. Earlier planning scenarios reached roughly $1.75 trillion, but that was not a final target. Reuters Breaking Views cited estimates of roughly $15 to $16 billion of sales and about $8 billion of EBITDA in 2025. The market is clearly pricing SpaceX as more than a launch company. The question is how much execution is already embedded in that price. Starlink is where the business starts to look like a platform instead of a pure launch company. The report says SpaceX operates roughly 9,400 satellites, and Reuters noted FCC authorization for additional Gen 2 satellites in January 2026. That scale creates network effects, recurring revenue potential, and a distribution footprint that is hard to copy. Scale also creates obligations. SpaceX has to keep replacing satellites, manage spectrum compliance, and reduce collision risk across a massive fleet. The VON direct-to-cell deal and the planned altitude change show how Starlink is pushing into new use cases while still carrying real operating risk. SpaceX's moat is systems capability. It designs the vehicle, builds the hardware, launches the rocket, manages the satellite network, and feeds the lessons back into the next iteration. That loop is hard to copy because it combines engineering, manufacturing, cadence, and reliability in one organization. The cadence data in the report makes the gap tangible: Falcon 9 at 165 launches in 2025 and Starship at 5 attempts. Reusability does more than cut cost. It compounds learning. That is what keeps pushing the curve down while competitors are still catching up. Blue Origin, United Launch Alliance, Rocket Lab, and Arianespace each have a niche, whether it is capital, government relationships, small launch execution, or European support. None of them currently match SpaceX on cadence, commercial scale, or the launch plus satellite combination. The broadband race is tighter than it looks. Project Kuiper, Eutelsat OneWeb, and Sovereign Systems all add pressure. The lead is real, but it has to be defended. In communications, early advantage is valuable only if execution stays ahead of the copycats. The main risk is not weakness. It is overpricing perfection. The report highlights Starship execution risk, on-orbit anomalies, FCC and FAA approvals, spectrum rules, and environmental review. Any one of those can slow cadence even if demand stays strong. There is also governance and concentration risk. SpaceX is private, disclosure is limited, and decision-making is unusually centered around one founder-led structure. Add the capital intensity of replenishing a satellite fleet, and the thesis becomes clear: this is a strong company operating inside a very demanding risk envelope. The bull case is straightforward. Starlink keeps growing, margins stay strong, direct-to-cell and enterprise offerings deepen the stack, Starship begins to scale, and launch costs keep falling. In that world, SpaceX becomes a much larger platform than the current revenue mix implies. The bear case is just as clear. If competition compresses growth, regulation slows deployment, Starship slips, or capital markets start to discount governance risk more aggressively, the multiple can compress fast even if the company stays excellent. The range is wide because the execution path is still wide. The right conclusion is disciplined, not sentimental. SpaceX looks like a very strong company, but not automatically a great investment at any price. Operationally, technologically, and strategically, it is one of the most impressive private companies in the world. But valuation, access, and governance still matter. Admire the business. Respect the risk. Keep price front and center. If the market eventually gives SpaceX a meaningful margin of safety, the upside can be compelling. If it prices in too much perfection too early, even a world-class business can become a poor entry point. Educational content only. This video is for commentary and analysis, not investment advice. Use multiple sources, manage risk, and make your own decisions. Educational analysis can reduce decision noise, but it cannot remove risk. Treat every view as a hypothesis to test with your own data and constraints. Educational analysis can reduce decision noise, but it cannot remove risk. Treat every view as a hypothesis to test with your own data and constraints.